Welcome to TheoTrade. This is Don Kaufman. It's June 2nd, 2018. You are watching the Theo Weekend Update. All right, let's start with the fact that we just passed through a holiday week, only 4 trading days within the given week. And I have to tell you, from my perspective, it felt like one of the longest short weeks we've had in quite some time. I mean, look at some of the moves that we got inside of the SPX specifically on a day-to-day basis. We'll kick it off with Tuesday. And Tuesday we saw a 31-point move to the downside inside of the S&Ps. And Wednesday we had a 34-point move to the upside. But wait, there's more. On Thursday we sold off by 18 points and then turn around on Friday to go 29 points higher. What does it amount to? Well, almost absolutely nothing inside of the S&Ps. I mean, we were not massively unchanged, but we were mildly to the upside inside of the SPX. The Nasdaq, however, and the Russell are actually facing near all-time highs. Again, the Russell pretty much hit its all-time high throughout the course of the week. The Nasdaq stone's throw off all-time highs. But I want to kind of digress for just a moment back to the point of the moves on an intraday basis. This is something that I have just been bringing up kind of day in and day out, whether you're in the TheoTrade chat room or whether you're tuning into these nightly videos. I keep talking about buy options and buy options, especially on an intraday basis. I just cannot stress this enough. Okay, why? If you remember back to last weekend's video, I said outright it's a buy of options, but the reason we were saying that is we were expecting about a 33-point move inside of the SPX. Now, how again do we derive the 33-point move? The options market was depicting movement of about $33. And how does it actually come to that? For the most part, if you look at the options, okay, that have about a week to go to expiration, you add up the at-the-money call to the at-the-money put, it equals somewhere around $33. Okay? However, you have $33 that we're expecting to move, okay, for the entire trading week. Whether that trading week is 4 days, whether it's 5 days, is neither here nor there. But you're supposed to be able to move like this $33 kind of range. Yet almost every day this past week, we moved that and more. I mean, again, we had a 31-point move just on Tuesday and a 34-point move back to the upside on Wednesday. We had a 30-point move on Friday. This is opportunity. And I think a lot of people miss some of those opportunities. And I'm going to really give you a quick summation of just that. Short duration options are a buy right now. Okay? If you want to sell options premium, you got to consider going duration. You got to start going out, 70, 80 days. And it's something I'm actually going to be talking about this week here coming at TheoTrade, is selling a little bit more duration to help finance buying options even on an intraday basis. A few other aspects I also want to discuss before we get into some of the charts. We made a lot of calls in the last week or two, specifically about bonds. We made a lot of calls about the emerging markets. We made a lot of calls about financials. Okay, just to kind of run you through a few of those. First and foremost, we saw bonds rallying, and we specifically said the other day when the bonds start to hit about that 145 region, they're probably going to reverse, and exactly that played out. We also looked at that as well inside of the dollar. Nevertheless, I don't typically trade some of the currency products. We just watch the currency product. Why? The currency products help us actually delineate what's going on inside of the emerging markets. What were we looking for in the emerging markets? Well, just the other evening, we put on a bullish trade inside of the emerging markets, and we got that nice bullish move specifically today when the emerging markets, they haven't done very much this past week. We finally got that bounce to the upside. There's probably a little bit more follow through to the upside in the emerging markets. However, I want to make this very, very clear. I am still long duration bearish in emerging markets. It was the short duration bounce that we happen to be looking for. Now, let's actually get a little bit away from emerging markets. Let's move away a little bit from bonds for a second. Let's talk about the financials. The financials, again, some very, very bold calls in Morgan Stanley. Morgan Stanley did back off to the 50 marker before it bounced back up. But financials, generally speaking, have been extraordinarily weak. We're going to show that here, again, momentarily. And we're actually going to give you a little bit of a feel of what we believe the financials are going to do, because they're the key sector that happens to, in fact, be holding back the S&P 500. If you haven't looked at the comparison, and this is also something we've been doing lately, we've been comparing the S&P to the Russell to the Nasdaq, but if you haven't looked at the comparison lately, the S&Ps are currently drastically underperforming, okay, both the Nasdaq and the Russell in very recent trade. A lot of that, again, has to do specifically with those financials. One last thought before we get over to the charts, and it has everything to do with historical volatility. Historical volatility is the annualized standard deviation of the past stock price movement. What exactly does that mean? Absolutely nothing. For the most part, what it means is how fast an underlying happens to be moving. And we were talking a lot about, options are a buy right now, but this is historical volatility. This is how much the market is moving. In just a moment, I'm going to show you some really interesting areas of historical volatility that I think are going to shock you. With that, let's get to the charts. All right, getting to the charts, let's start with the S&P 500 futures, that is the E-mini S&Ps. And if you've never heard me say this before, well, I'll say it about 1,000 times. You gotta know about futures products. Why? Because futures drive order flow to the marketplace. With that, we have talked ultimately until we're blue in the face about some very, very specific levels inside of the S&P futures. And, a couple of moments ago, I was talking about making a few bold calls in here. And one of the bold calls we've been making happened to deal specifically with these futures. Right here happens to be what? 27.31. Down below happens to be none other than 26.82. Obviously, these are the levels that are in play. And then what you happen to be looking at is a 30-day 1-hour chart. And this is really where the week began, which the week began at 27.31. We literally ripped right down to the 82 to do nothing more than take right back off to the upside. Missed the 31 by a hair, by 1 point over here. Sold back off on Thursday, rallied back up on Friday. I mean, this is really, it's one of the more schizophrenic markets that we've had. Now, we sit poised, okay, as this next week begins, we sit poised to actually break through to the upside. And specifically, what would be driving us to the upside, okay, is none other than the Nasdaq. Now, the Nasdaq did finally break its range, cruised above the 7,000. 7,000 has pretty much been top of the market. And again, this happens to be a 30-day 1 hour. You're going back right now into the last few weeks of trade. 7,000 has pretty much been, it's been the marker to break. And we did just that today. So it's a breakaway and a runaway to the upside inside of the Nasdaq. However, at the exact same time, if you switch over to the financials, okay, the financials happen to be defecting to the downside. Sure, they bounced by a tune of about 1% today, but earlier this week they got decimated and very slightly recovered as this week kind of progressed. With that, and before I really start to geek out on you, we've got a couple of other kind of what I would term more bold calls. First of all, okay, going to go back to the S&P. And again, this is what, people keep emailing me. They're like, I want some bold calls, and I'm going to give you just that. Lots of people like some of the bond calls, the emerging market calls, and those are exactly the products I'm going to go back into. So one of the things that I first want to make in terms of a little bit more of a bold call happens to be specific to the S&P futures. I actually do think we're going to see some follow through to the upside. However, I think that follow through to the upside is going to be rather minimal. What am I saying? Well, specifically, I think there's going to be follow through to the upside. We're going to come up, okay, and reverse course ultimately from there. Why? It's going to have a lot to do with the dollar, but more importantly, okay, we are probably going to once again have some bond fears. Now, when I say some bond fears, what I would anticipate going on in just the next couple of trading sessions, next week or two, is the bonds, okay, which did rally up when we talked about them getting right to the 145 level. They're there. They were going to reverse course, and that's precisely what we got. Well, the interest rate fears just keep coming up again and again. And in fact, if you look at the entire marketplace, let's move away from the bonds for just a second and the S&Ps for a second. If you look at the entire marketplace right now is almost like this haunted house that you're going to walk into. Right? And you think about there, like, what's the analogy there? You know, you walk into a haunted house and you recognize, you're like, I'm about to get the crap scared out of me. I just don't know exactly when. I don't know exactly where. All of a sudden, surprise, it's interest rates. Okay, you walk a couple of, a few steps, further than that, and surprise, it's what? Oh, it's North Korea risk again. A couple of steps further than that, surprise, it's tariffs, and all of a sudden, trade war. I mean, really, it's getting a little bit old, but it's like cyclicality in nature of some of the surprise. So I call it, the house of horrors, pretty much, of a marketplace. And I do believe that those are going to continue to resurface. So again, in the short term, everybody's looking for the upside. They're like, that's it. We're finally going to break the range. And we are probably going to break the range to the upside, okay, and then come back into it. And again, you want to key into specifically what the financials are doing. Again, the financials, we think we're going to have a little bit more upside and the exact same thing. They're going to drop and drop hard. Now, I'll come back to the financials in just a moment. Another call I want to make that's a little bit more bold. There's going to be some continuation once again also in the emerging markets. The emerging markets are going to feel just like the financials, trade either product. They're both massively liquid, right? Whether it's the XLF, whether it's the EEM. Inside of the EEM, again, a little bit more upside, okay, before coming down hard and fast. Okay. Another financial underlying that I do want to talk about that I've had extensive positioning in is none other than Morgan Stanley. First of all, okay, I want everybody to recognize that I have been and continue to be long duration short in here. Okay, I have carried short positions inside of Morgan Stanley really since almost the beginning of 2017. I am shorting Morgan Stanley, okay, and I happen to be using deep in the money puts in effort to do so. So you'll see positions in here where I'll actually purchase a deep in the money put, and I'm usually shooting, okay, for a fairly high delta deep in the money put to effectively create a short position inside of an IRA. Now, in the short duration, again, bounce to the upside, okay? Morgan Stanley, why do I single it out? Because at this point in time, this is an underlying that I believe stands the most to lose. And even though in the short duration, I still think we're going to have a little bit more of a bounce, the 50 marker, the 50 level in Morgan Stanley holds tremendous weight. Cracking below 50 could provide us some really decent downside opportunity. I think we have a clean shot well below even like 40, 48, mid 40s possibly inside of Morgan Stanley if we're to break below the 50 level. The reason that I kind of wanted to, I guess, delineate a little bit more about Morgan Stanley is it's got an excellent risk reward right now. That is, what's the upside potential, okay, versus the downside in here. And it's not often that I say this, but at this point in time, there looks to be a phenomenal downside versus upside potential. And that's the kind of risk reward, okay, that I'll typically seek in a lot of different trades. Now, let's spin things back around and let me, for just a moment, I'm going to kind of geek out on you. When I say geek out on you, all right, we already got to the house of horrors, but let me go over to the SPX. And the SPX, we've been marking these expected moves on a week-to-week basis, just so everybody's aware. Even though the market, okay, did rally a little bit. And again, this is the week at large, and it's a little difficult sometimes to see with all these lines on here. Again, these lines kind of indicate the expected move. This was, again, the week that we just passed through. It's 1, 2, 3, 4 trading days. Remember, we started the trading week right around 27.22. Where did we end the trading week? Right there at 27.34. So we got everywhere to get pretty much nowhere. I mean, yeah, we had some mild upside by the tune of about 12, 13 points in the S&Ps, which is almost a rounding error when you look at a $2,730 product. Now, in this coming week, once again, we have about a $32 expected move. And there is the irony, okay? And you're like, well, what's the irony? The irony is we've seen $30 moves almost every day this past week. And yet, when you look at the expected move, it's only $32, which once again, we have a week where we're going to be screaming, buy option premium, buy option premium. Why? Because you got option premium that's pretty much at the money in some cases, literally at the money options that are trading for $15. What does that mean? Well, you could buy an option, be dead wrong, and the very next day buy an option, Be dead wrong. And the third day, you buy an option and boom, you're right. And that's going to pay for the mistakes that you made in the previous 2 days. Why? Because the premium for the entire week, whether it's a call or put, it's like 13, 14 bucks. Figure it out on paper. Okay. And I've been reiterating this point. You don't necessarily have to be right in effort to be able to make money. All right. So one of the things that I wanted to show you that I found quite entertaining, and I think a lot of people are missing this. I'm going to turn off all the different drawing sets. Okay. I'm going to cruise up over here to style. I'm going to go load style. And all I'm going to do for just a moment is throw on here historical volatility. Now, historical volatility is the annualized standard deviation of the past stock price movement, yada, yada, yada. It's how much the market's moving, okay, over a certain period of time. And effectively what I've done over here, as I've showed you, historical volatility, okay, on a 5-day window. Now, why am I doing like averaging 5 days? It's because on a week-to-week basis is what we're doing for, again, implied volatility. So implied volatility is saying we have about 10% implied risk. But if you take a look at historical volatility, it's up to 17%. Now, I got to highlight that for just a second because this is what I've been reiterating day in and day out, is that the market is moving way more than the options marketplace is depicting. So, you know, they call it implied volatility for a reason because it's implying, okay, if you look at the implied volatility in the SPX, it's 10%. And some people go, oh, I don't really get what 10% means. Well, if you don't necessarily understand the SPX and implied volatility, look at the VIX, okay? Because a lot of people point out, oh, it's a 13 VIX, the market's totally dead. Guess what? The VIX is totally dead. And when I say the VIX is dead, I'm saying like the VIX product is ineffective right now to be able to look at, other than to say like, oh, the VIX is at 13. But we're moving, people. And we're moving a lot. And let me show you something that's really, really crazy, some individual sectors. So right now, buying options premium in the S&Ps. Now, if the SPX doesn't do it for you, okay, go to the spiders. Why? The spiders are a softer, gentler version of the SPX. And the SPX is like literally the mother of all products. Go to the spiders. You're not going to get killed. Again, buying option premium in here can be really, really effective. Instead of trading this, $2,700 product, you're trading a $273 product, right? So I just wanted to kind of clarify that. Now, moving forward from the spiders, get ready for this. Check out the XLF, all right? None other than the financials. We've been talking about them for the last, 5-10 minutes here. The financials, this is, again, historical volatility. It's the actual price movement. It is absolutely rocking. I've mentioned this so many times, you almost have to like redefine what you think volatility happens to be, because the historical volatility is up to 32%. It's like jaw dropping. Why is that jaw dropping? Because now we're going to go over to the XLF and we're going to look at the XLF, and what? The implied volatility is 17%. All right. And listen, I've seen some crazy stuff in my day, but how is actual price movement double what implied risk is saying? Basically what it's saying is, in the short duration, don't you dare sell anything. Now, I do think there's opportunity to sell premium in the future, okay? You just got to watch out in the near term and short duration options. Options got like a week or less. You really got to consider buying option premium. Now, here's actually the craziest of all of them, and it happened to be specifically in the Nasdaq. So then I looked over at the Nasdaq. So I'm looking at the SPX, and I'm like, wow, historical volatility is through the roof. Then I looked over at the the financials, and it was jaw dropping. Then I'm like, okay, I'm going to go over the Qs. Why am I going to go to the Qs? Because the Qs look like they're rocking. Yeah, well, take a look at the historical volatility in the Qs. Okay, it's sputtering. There's nothing going on. The Nasdaq volatility, the actual movement in the Nasdaq, is dead. So the Nasdaq's moving at a rate of about 12%. Okay? If you look at the 7-day options, guess what? They got it spot on. The Nasdaq all of a sudden it's the odd product out. This is the product that you do not want to be buying options in. The product you want to be buying options in is going to be the spider. It's going to be the financials out there. And that, people, again, is of absolute critical importance in this coming week. Now, also in the coming week, I'm going to be talking extensively about, hey, how can we possibly buy options? Again, buy options in the short duration, but then we're going to turn around and we're actually going to finance some of those positions. And you can see I've got positions even 77 days out. We're going to finance those positions by selling duration. Be on the lookout. I'm going to discuss it extensively this coming week here at TheoTrade. Thank you, everybody, for joining us here at TheoTrade, and have a wonderful weekend. Bye-bye.